Cash Cash, March 7th, 2023. And today we're taking care of customers. But one of the things we do here is we teach lessons in regards to different ways on how to make the most of your money, save some money, get the most bang for your buck, and really look out for consumers and things that are really huge and important to them. One of them would be in real estate, all right? And so whether you are a first-time home buyer, whether you're a repeat buyer, or whether you are a real estate agent who has a buyer, what I'm going to talk to you about here is going to be pretty important, all right? And so what I'm calling it is buying basics. And in terms of buying basics, I mean, that's pretty self-explanatory. It's just the basics of purchasing. Okay, so the one thing you want to do if you're a realtor, and the one thing you want to do if you're a buyer, is you actually want to know if you're qualified or not, and the realtor wants to know if you are qualified or not. And the reason for that is no one wants to spend hours and hours driving a potential customer around if they can't even be a real customer, and you don't want to spend hours and hours looking at homes only to be teased, not knowing that you can't actually purchase a home. All right. So one of the first things you need to do is get pre-qualified. And Stash Cash today on March 7th, 2023. Here are some of the steps that you need to do. Number one is you need to complete a mortgage application. If you're looking for what it looks like, you can Google the numbers 1003 or what's called a 1003. And you can find that on Google. It's a document that asks you for, quite a few things. Number one, it'll ask you for your personal information. So your name, your date of birth, your social, where you lived for the last 2 years, right? So that's mandatory, that's minimum. The 1003 is also going to ask you about your employment history. So over the last 2 years as well. So if you've moved jobs within less than 24 months, you need to include that. It'll ask you the actual company name that you work for, what your position is, how long you've been in the industry, or they'll ask you that. It'll ask you for a phone number, and it'll also ask you about how you get paid, which you get paid on a monthly basis. So um, when I'm when they're asking about that, they're asking about gross pay. So if you're a W-2 wage earner and you make 120,000 a year, your take home per month is, I'm sorry, your gross take home is 10,000. So they're not going off the net and off what you take after taxes are taken out. They're looking at what you gross. Okay, and so you're going to give it to them annually, or if you can give it to them monthly, and they can extrapolate the information that they need in order to get you qualified. The other thing that you'll need to supply if you're a buyer is your last 30 days income. Right, the 30 days pay stubs would substantiate what you're saying on the application. Number one. The other thing it will do too is it will show that you are, or for the last pay stub, you have been employed. It might also show some things on the pay stub on there, like maybe things being taken out for payments. And so any underwriter in the mortgage company that you're working with will definitely need to see that. Also, what they would look for is your most recent W-2 forms, okay, or you need to supply that. If you're in between, filing taxes, like right now, it is March, then they would ask for also your last 2 years federal tax return. So not the state, but just the federal. So if you haven't done your taxes yet and you have, 2021 and 2020, they'll ask for you to send that upfront. And if you get your loan completed before the tax deadline, April 15th, then you might just be able to get away with those most two recent federal tax returns. If not, and it goes past April 15th, then you're going to need one or two things: either your 2022 taxes or the latest tax year's taxes, or you're going to need to get proof of extension. All right. And the tax returns are pretty important too, as they might contain some other bits of information which could actually affect your income. Okay, so whether that's up or down. Um, Also, what you need to submit in, or what underwriting would ask for, or your loan officer would ask for, are your last 2 months' bank statements. The reason for that is they want to see where you're going to get your down payment from. And sometimes not all your money is in the bank statement, so they're going to want to see your asset statement. So, what are those things? Things like a 401k, 403b, or things where you can draw money out of to actually put into your home, and at the same time have reserves. So, what are reserves? Reserves are simply this, right? Like, let's say you bought a home and you spent all your money on, like putting your down payment in and your closing cost and everything else. Okay, well, most lenders don't want to see that you have zero left in the bank. Otherwise, did they actually do the right thing for you and do your loan? I mean, there are some programs where that doesn't matter, but for the most part, they want to see maybe at least a couple months of reserves. And those reserves are comprised of this: your 2 months principal and interest payment, that is your basic mortgage payment; 2 months taxes, property taxes; 2 months of your insurance, homeowners insurance; and 2 months of your HOA if there is an HOA. All right. Also, back to the bank statements really quick. The one thing that they're going to be looking for as well, because let's say you do have a W-2 type of income and it's coming direct deposit and it's going into your bank account. They just want to see, and it'll show on your bank statements that, hey, listen, XYZ company is making deposits into your bank account for payroll. Now, if there's some unusual deposits there, like let's say large cash deposits, then they may question, the validity of what that is, or they might actually ask, hey, what is this? Provide a letter of explanation. If it can't be somehow traced, or if it's not valid to them, then let's say, for example, you had $100,000 in your bank account and there's a large $50,000 deposit, and you can't um, state a valid reason why it's there, then you're only going to get credit for the remaining 50,000 and not get credit for that other $50,000 deposit. So that's a pretty important thing to know when you're looking to get qualified. Okay. And yeah, sure, there's some companies over there that deal with private investors where you might not need to turn any of this stuff in. But if you don't do that, just remember you're kind of going against the grain, and it is more risk to the lender. So if it's more risk, how do they make that up? By charging you more, and typically that's going to be in terms of a rate, or maybe some extra fees on top of that as well, or maybe you have to put more down in order to secure that loan. Okay, so what happens once you submit this all to your loan officer? The application, which typically they'll take over the phone, the 1003, they can do that over the phone. Your most recent 30 days pay stubs, your most recent 2 years W-2s, your most recent 2 years tax returns, your most recent bank statements and asset statements. All right. Well, what they'll do is they're going to run that, they're going to enter that information in the system, and then they're going to run it through the system and see if it qualifies you for a purchase price that you're looking to get. All right. If so, then you get a pre-qualification letter that you can take to the realtor. Okay. And realtors, if you're watching this, you could actually take that letter, that qualification letter, and turn that in with your offer, okay, your offer to purchase, and see if the seller actually takes it. Could be good enough, right? One thing I would suggest, if you're a buyer or if you have a realtor who is a buyer, is never max qualify them out. I mean, it's good to know what they can qualify for today, but I would always just ask realistically what they are looking to purchase. The issue with max qualifying anybody is that if the market takes a turn for the worst, automatically they may not qualify anymore for the home that you had max qualified them on. And I've actually seen that in a real estate office where there was a buyer's agent and there was a listing agent. A pre-qual letter was turned in a long time ago, but it was max qualified out. There was a change in the market. Um, they thought they were gonna they thought they actually had the deal done. Obviously, the rates took a turn for the worse, and now they couldn't buy the home. So I would just kind of make sure that there are some built-in pads over there. So if I could max qualify someone for $1 million, great. But I would first ask them realistically, what are you looking to purchase in terms of a sales price here on a home, and start from there. Um, Now, let's say you submit in your pre-qual letter along with the offer to purchase, all right? And your realtor does that for you and you get it, they say yes. So that's your offer acceptance. Okay, so what are the steps now once you get your offer accepted, aside from jumping for joy, right? And this is Stash Cash today on March 7th, 2023. You would actually submit what's called a fully executed purchase contract. That purchase contract, fully executed, means that it's signed by both parties. Okay, so the seller side and the buyer side. So everyone agrees to the contract, the terms, the price, etc. Okay, there could be some amendments or addendums to the contract that obviously would both sides would need to sign as well, and that's part of the contract too. If there's any types of adjustments, the buyers now, okay, so realtor is your buyers, or if you are the buyer, you're going to need to make what's called an earnest money deposit into escrow. And so when that contract's being written out, they'll let you know how much is acceptable. So, say for example, you're buying $1 million house, and you come upon that fully executed purchase contract. They might say to you like, "Hey, we need 20,000 or 40,000 at escrow." So, escrow is a third party entity that basically deals with all the monies, and that money is sitting with them as you know intent to purchase the home. So it goes with your contract. All right. What happens from there now is the lender, whoever you choose as the mortgage company and your loan officer, what they do is, uh, if I was a lender, I would actually submit in the purchase contract fully executed, that means signed again, with the addendums or amendments fully signed or executed, and the latest income and asset documentation into underwriting. So why did I say the latest income and asset documentation? Well, let's say I pre-qualified you 30 days ago. Well, now I need your latest 30 days of income. Okay. The bank statement that you turned into me, one of them now, since I asked you for your last 2 months, one of them now is going to be over 60 days. So I would need the latest ones. Okay. It's and just keep this in mind, right? If you have any documents in between your file when you're submitting it in to a loan officer, just make sure you always get them the latest ones because they're going to need them anyways. I've seen one of the biggest holdbacks in closing a loan sometimes be on the buyer side because they piecemeal everything in. And when you do that, then your file just kind of goes back and forth. It's always better to submit everything in, preferably at once, than to try and do it one at a time. What you want to avoid here is ping pong with the underwriters. What that means is I'm submitting a file as a lender from you, whatever you gave to me, to the underwriter. Okay, that could take a few days for an underwriter to take a look at it, and only for them to tell me, "Hey, I need this," and then I need to get it from you because you didn't get it to me the first time. Like the example was, you didn't give me your latest 30 days income. You gave me ones from 60 days ago. So now I got to resubmit it back in, and now it goes online again. Meanwhile, the clock is ticking on you because you might have a 30-day escrow, meaning 30 days to close the deal. All right. But before I get too far into that, here's what here's to continue the offer acceptance. At that point that you have a fully executed purchase contract, you as the buyer slash borrower, if you're using a mortgage company, can now actually lock in your rate because there is an agreed upon contract. Whenever you're getting pre-qualified and there is no contract, there is basically no home yet. There's nothing really to lock the home or to lock the rate against. Okay, so you can never lock a rate on a pre-qualification, only on a fully accepted offer, right? At this point, too, the appraisal can be ordered once the offer is accepted and the lender is now submitting in your file. So what is the appraisal? The appraisal is basically going to be the value of your home, which will be done by an appraiser who's disinterested, right? And nowadays, mortgage companies and loan officers can't even talk to the appraiser to order the appraisal. That normally just gets picked at random by your mortgage company if they have an accepted appraiser's list. All right. So if the appraiser goes out and then submits in your value or your final appraisal, it'll eventually get to the mortgage company, and then as long as the appraisal matches the purchase contract or is more than a purchase contract. So let's say you agreed for $1 million purchase and the appraisal came in at $1 million. Hey, great, right? If it comes in over, hey, even better for you. You already have some equity in the home, meaning that and here's what equity is. Equity is the difference between the loan or what you owe versus the value of the home. So if the appraisal happens to come in lower, then what can happen now is your loan is going to be based off of the lower of the sales price or the appraised value. So what if the appraisal comes in at 950? Well, you and the seller would have to communicate along with your realtors, listing agent, buyer's agent, to see if you can negotiate a new price. Because if your intent was to do a specific loan amount based off that purchase price, it might not work now because the numbers won't work. Um, So you're going to have to work that through with your loan officer and the other party, meaning the listing agent and the seller side, right? So now what comes in is, eventually after a few days, hopefully sooner than later, is loan approval. Okay, so if you get loan approval over there, you get what's called a conditional approvals list. This is what the lender gets from the underwriter and the mortgage company. The loan officer will work to clear those conditions list. So what can a condition be like? Okay, well, the condition can be like, hey, I need to get the appraisal back. Um, okay, and the appraisal needs to come in and at least say this much. Or, hey, you know what? I need a letter of explanation on this unusual deposit in your bank statement. Can you tell me what that is? All right. So, or it could be, hey, I need your other missing pay stub or your tax return wasn't signed on page 2. So those little things like that, right? You can get those cleared up pretty quick. But the point I was trying to make earlier is if you can get it in clean, there's less conditions to take a look at, and it will your loan will go so much faster. Now, at that point, like a home inspection could be ordered, okay, by your realtor. And what that does there is like a lender doesn't normally need to look at a home inspection ever. But what that does for you as a home buyer is it makes sure that, you're purchasing a home where everything's going to be fine, right? There's no electrical issues. There's nothing that you should be concerned of in terms of a buyer as you're buying that home, because that could be the worst thing, right? So you close your loan, all goes well, but next thing you know, you have like these little things that are wrong with the house, and the homeowner's inspection should pick that up, right? Now, loan contingencies can be removed What that basically means is now you're gonna moving forward. You're gonna be moving forward fully with the loan now, because maybe your conditions are really nothing to worry about. It's just like, hey, give me your last pay stub, or hey, give me your latest bank statement, or hey, give me a letter of explanation. Um, versus something major like, hey, I can't substantiate this big deposit, your loan could be in jeopardy, right? So you can remove your loan contingencies at that point. And normally a lot of realtors or a lot of contracts want you to remove them within 17 days of the offer acceptance. So this is why I keep repeating back to this at Stash Cash on March 7th, 2023, that you need to submit a full package as much as possible. Okay, because these dates can come up on you really quick. Also, if the appraisal comes back within 17 days of when the file was or the offer was accepted, and it comes in satisfactory, you can remove your appraisal contingencies as well, right? At this point too, you may want to be looking for homeowners insurance. You could look for it sooner, as soon as the offer was accepted. But a lot of people like to get it right when their loan's approved. It's pretty simple in terms of homeowners insurance, getting that ordered. Um, Here's a hint for you though, before I go any further on loan approval, and this is in regards to homeowner insurance. And this is something that I need to make sure you guys do properly. We know that you want the lowest rates. We know that you want to pay the least amount of premiums. However, this is probably going to be your biggest investment, especially if this is your primary residence, and the investment that might mean the most to you and your family. So my advice would be to make sure it's protected by a trusted homeowners insurance company, because not all insurance companies are made the same. And you just want to make sure that happens, because should something happen um, to the home and you get that discount insurance company, expect discount service, expect maybe a discount experience, and expect maybe having a lot harder of a time, or virtually maybe no guidance on what to do. If you work with somebody who is a trusted agent on your homeowner's insurance, then you know what? Hey, this could be a lot better for you, because if you're going to live in a home for quite a long time, there's a pretty good chance a couple things could come up where homeowners insurance, could be used. Like, for example, what if you have a kitchen fire, all right? Or what if a pipe burst? Or what if there is a liability issue, like a slip or fall? Okay, or you have a dog and it bites somebody. Or like, let's go back to that fire. If the house is not now livable, you need to go stay somewhere else and exercise your loss of use, which pays for where you stay and your food, for the time that you cannot lose your home, or you lose the use of your home. So, anyways, on the homeowners insurance piece too, one more tip you might want to do is look at your car insurance. And if they offer homeowners insurance, you might want to bundle. But, once again, right, if you're looking to protect your home, I would recommend that you actually go to a respected and well-known homeowners insurance company, to make sure that you secure proper insurance, all right? And if that means like, hey, maybe getting a car quote as well to bundle everything to make sure that you get those discounts, then hey, great. Go ahead and do that. I mean, I think it'd be worth it. Um, Back to the loan approval now. You know, Sometime in the loan approval, especially when they're nearing the end of the approval, they're going to get what's called a verification of employment. Sometimes it's written, but they always do a verbal as well. So what does the verification of employment do? Or in this case, well, number one, verifies that you're employed, right? That's the easy answer. But it might say things like, let's say, for example, you're getting a bonus. That written verification of employment might spell out there over the last 3 years, how much of a bonus you actually got. Because if that is part of the income that you're using, then as a lender, they want to make sure that they're lending to somebody, if they're using their bonus, who is getting a consistent bonus. Otherwise, they might need to adjust your income. All right. The other thing that they want to know is, how likely are you to remain employed? And that could be on a written verification of employment, but also on the verbal, before they let the docs go out, the documents, meaning your loan docs, is they'll call in and they'll just ask, your HR department or whoever verifies your employment or your supervisor, hey, does John Doe still work here? And is he currently employed? And, if they say yes to those things, then it could be as easy as that for passing verification of employment. So once all those things have been taken care of, like the conditions back to the underwriter, um, the appraisals back, the contingencies are removed, the appraisal, loan and appraisal, the insurance, homeowners insurance now is ordered, or at least a quote, verification of employment is now requested. Uh, you know, you could be going into what's called, your final loan approval. Okay. And at that point, if everything gets signed off by underwriting, all right, and back to your homeowner's insurance, they might ask your homeowner's insurance company to supply evidence of insurance with the effective date of when you are supposed to take that residence. Okay, so like if the effective date is April 1st, then they'll ask your homeowner's insurance person or agent to supply evidence of insurance, which starts on April 1st. So now you're in the loan closing, right? So once you're in the loan closing, this is when all things are clear from underwriting and the lender, and they'll actually produce loan documents for you to sign. These loan documents, they could be pretty thick, all right? Actually, on March 7th, 2023, there are loan documents which could be like this thick, and you could be tired signing them. But they definitely do need to be signed with the notary. And the notary is going to go ahead and witness your signature. And they're going to put their notary stamp on what needs to be notarized. And oftentimes, these loan documents, which are signed by you, the buyer, or for the realtors, your buyers, they're going to be signed a lot of times at escrow. Why? It's because, sometimes it's a lot easier. Escrow has their own set of documents, and they put that on top or with the loan documents from the lender, and they have everything just signed together. Could they get a mobile notary to maybe go to your place of work or your home, sign? Sure, right? They can do that. The thing is, right, if there's a little mistake that might need to be fixed, now they're at your home and there's really no way to refix that paperwork. They have to either get that back from the lender or go back to escrow and get it. And therefore, a lot of times it's recommended that you sign at an escrow company if you can. The other thing too is if a notary comes out to see you, they may probably charge a traveling notary fee, which just adds to your cost. All right. Um, Once those documents are signed, the uh, the loan documents, escrow documents, they're going to go back and go to the lender for funding. Okay, they will just want to make sure that everything is in its place. You've signed where you need to sign. There's nothing additional that comes up. And at that point, they're working on funding, or the funding department's working on funding your loan. Once that happens, then the funds can go to escrow, and then your funds you can bring to escrow. So, like, say for example, on that $1 million purchase we talked about earlier, right? You put down, or not, this wasn't your down payment, but you gave um, escrow a $40,000 earnest money deposit. Your down payment, okay, was 20%. So 20% of $1 million is 200,000. So escrow has 40,000. You need to bring the remaining 160,000, all right, to escrow plus any fees, any additional fees. Like, what are those fees? They could be like fees from the lender, property taxes, the payment for the insurance, etc. the 160,000 to make it 20% down plus any other fees need to be brought to escrow. Okay. And a lot of times that's done by a wire. Escrow will give you wiring instructions and you would wire over that money to escrow. One tip that I have is you might want to, wire a little bit more and maybe wire it a little bit sooner than right after you sign your docs, right? Because you might already have an idea of how much you have to bring in. I would actually, wire in more than what's required and wire it, if you can find out the figures before you sign, wire it before you actually sign. Okay, so if you find out the night before and you're signing tomorrow, go to the bank the day before and wire it. Why would you do that? It's just one less step. Why'd you wire more? Just in case there's any type of changes in the figures that come up unexpectedly. Okay, and all that's going to happen is once you know the loan, once everything closes, escrow is just going to turn around and give you what's called a closing package, which is the final escrow settlement statement. And if there's any monies that are owed to you, they're going to give you that money back. So for me, it's just peace of mind, and I actually did that when I purchased my home as well. Um, Now, once the wire goes to escrow, everything's clear. They fund out the loan, all right? Title company can now record that will can now go to the county recorder's office and record that you are the new owner of the home. Once that actually happens and it gets recorded at the county recorder's office, yes, you are the legal owner of the home. And realtors, yes, your buyer is a legal owner of the home. And now realtors, you get paid and you can give the keys to your buyer. So congratulations, Jay, you actually own the home now. And so what happens now, right? So this is like kind of the post closing, which I just talked about, is that you get the settlement statement and then you receive your keys, and then also eventually you're going to get your first mortgage bill. Okay, so not right away, not the next day or anything, but look out for your first mortgage bill from the lender. So if you hypothetically closed, um, let's say, today in March 7th, it's dash cash, then your first payment wouldn't be April 1st. Not that it's an April Fool's joke or anything, it would be May. The reason why it is May 1st to be exact, is because interest is billed in arrears if you have a mortgage. So all the interest that goes on your mortgage bill for May 1st comes from, the month of April. And that's why. Um, anyways, some more things that you need to know, right? Here's just some bonus information. Um, when you're a buyer and a lender is qualifying you based on, obviously one of the things, the criteria they look at is your credit score, right? They look at the lowest middle FICO score. So what is that? So a FICO score, um, what that is there is that's your credit score, and there's three different credit repositories that grade you. So one is Equifax, one is TransUnion, one is Experian. And let's say it's two people buying the home, you and your wife. You might have a score, three scores. One of them might be 800, the other one might be 750, and the other one might be 700. And meanwhile, your wife is 700, um, 650, and 600. Well, what score will they go off of? They will go off the lowest middle credit score. So the lowest middle credit score would be your wife's 650. You have 800, 750, and 700. You have a middle score 750, and you might earn more money. But if you need your wife to qualify and she has a middle score of 650, because her scores once again are 700, 650, and 600, they're going to go off 650. Now, can that affect you? Yeah, absolutely. Because if you have a lower credit score, that they're using, then that's the worst case scenario that could affect your rates and potentially how much you have to put down. Okay, so if you're getting into maybe a more expensive home, maybe that score would have to be higher in order for you to put down less money, right? So those are just things to look out for there in terms of interest, in terms of credit scores. Now the other thing to note is that like when they're qualifying you on a home to see if you could actually afford it, they're looking at something called your debt to income ratio, okay, to see if you can afford the monthly payments. So here's what that is, right? But for most, so let's just use this in general. A lot of lenders use 45% debt to income ratio. So what they would be doing there is they would look at your gross income. So let's say you made 120,000 a year or 10,000 a month. What would be acceptable to a lender is if your total debts, okay, this would be your monthly, your principal and interest on your mortgage, meaning your monthly payment, your property taxes, which are split up into a monthly amount, your homeowner's insurance split up into a monthly amount, and then also your HOA if you have one, plus like your monthly car payment that might be due. And then the other thing would be possibly like any credit cards or any type of obligations that you owe. So if you're looking at your credit card bills, if you owe, 12,000 bucks and you have a monthly payment of $200, you might tell me you pay 400, but you know what? We're not going to use the $400 a month. That would actually not be good for you. We're going to use the minimum obligated payment. Okay, so now back to the example. If we're using $10,000 a month of income, then what that means is you cannot exceed all those things together, cannot exceed 4,500 or 45% of your debt to income ratio. Now, you might ask, right? Like, is there a way around that? Possibly. One of the things you could do if you have assets and the lender lets you do it is you can pay off some of the debt. So maybe the car loan, because that $800 car payment per month actually is a lot in terms of what a loan could bring you. Okay, because remember your loan's amortized over 30 years. So you might be able to do that if you have the assets and that's provable in what you've submitted in. So that's something you might be able to do, or you might be able to buy the rate down. What does that mean? Well, I'll go into that in a second, but basically, rates will vary depending on how you actually qualify, right? The type of housing that you purchase, whether it's like a single family a unit or a condo, or the other thing will vary on is your down payment, how much are you putting down? And then the other thing would be like the type of program, loan program you're using, if you're using a fix, if you're using an adjustable rate mortgage. And then the other thing is points, which was I was going to bring up to you right now. So if you ever hear a rate, like let's just say on a billboard or a commercial or radio, let's say it's 6%. Just assume, right? It's not entirely 100% correct, but assume that for the most part they're saying 1 point comes with 1 point. What's 1 point? 1 point is 1% of the loan amount in order to get the actual rate. So 1% of the loan amount as a fee to get the actual advertised rate. So in that $1 million purchase, let's say you put 20% down, you have an $800,000 loan. If you have a 6% rate, that means 1% of 800,000 is 8,000 bucks. That would be your points. Now, if you want to pay lower in rate, okay, it's like a teeter-totter, you might have to pay more in points. So now, if you need to get a 5.75 to get you to qualify because a payment on 6% is too high, you might need to spend some more money on points. You might need to buy more points. So now maybe instead of paying one 1% in points or $8,000, you might need to spend 1.5% in points or $12,000 in order to get your rate down maybe a quarter of a percent, right? So that's not always how it's going to be, but the market will dictate that, and your loan officer can work through those details with you. Okay, but that is important to know that you could have a way out um, in terms of if you get stuck, right? This is where an experienced loan officer is going to come in. Another thing you could do is maybe put more money down to lower your loan amount as well. You can do that too. And what if you don't have enough money, okay, to do any of that, to lower your down payment? Well, you might be able to get gift funds. Gift funds typically are going to come from a relative. Let's say you're a first-time home buyer, maybe mom or dad or brother or sister. The gift funds are fully intended to be just that, a gift. Okay, so they're not meant to be paid back at all. And you are going to be signing a letter, and so is the donor. And what it's going to say on that letter, it's going to say date, it's going to say to whom it may concern, and it will say, I, John Doe, am giving gift funds of, for example, $100,000 to Jane Smith for the purchase of her home at, XYZ Elm Street in who knows where, California, like 92000. Okay, so both parties would sign. Preferably, they'd like a phone number on there for more detail, and they're typically not going to call. And then the gift funds would either be deposited into your bank account. If it is deposited into your bank account, well, you've turned in your bank statements, but your next bank statement won't come until 15 days. Well, what happens, right? You might wonder, am I stuck? Well, no, not really, because what you can do is you can order after that deposit goes in, let's say it clears in a day or so, get the transaction history. That's a 45-day printout from the bank, which shows your transactions. Okay, if you're smart about this, you might actually question me and say, "Hey, the transaction history never has my complete bank account number, unlike my bank statement does, and it doesn't even have my name on it." Correct, 100% correct. But it's Dash Cash. We're here to teach you things. So what does your transaction history have? Has your transactions for the last 45 days. So guess what the underwriters can do? They can look at your bank statement, your latest one, and then also look at your 45-day history and coincide the transactions, because they should be the same amounts for the same dates, regardless of if you did any type of monies coming out of your account or deposits into your account. And that's how they can substantiate that the money actually, that this is the same account, and that the money actually went into your account, because it will appear there in your transaction history along with all those other transactions. And they're probably going to ask for a copy of the cleared check, okay, front and back. What'll happen here? This will have to go back to underwriting, right? Could delay your close, but hey, I mean, it's better than losing the home entirely. So those are like some little tips you could use. Now, the other thing you shouldn't do, or a borrower shouldn't do, realtors, if you have a borrower, especially if they're brand new, is go out and open lines of credit and buy a bunch of stuff during their process of buying a home and while they're getting qualified to purchase through their mortgage company. So why would that be? Well, basically because you don't want to accumulate any other debt. I mean, what if the mortgage company now has to rerun your credit because they discovered that you had an incorrect social on the application, right? If that was to happen there, and they see your credit report, and all of a sudden you have this open line of credit with a charge amount on there and this monthly balance that's owed, if you are just barely qualifying, I mean, that can potentially take you out of qualification, or you'll now need to go, possibly pay that card off. But that can slow things down, right? I've been looking at this for quite some time and doing this for quite a long time, where I've seen that happen in the past, and so you don't want to ever jeopardize purchasing your home. That is your goal, is to make sure that closes. Now, what else? Self-employed borrowers. Okay, so what you'll always need to submit, most likely, is what's called a profit and loss, because you don't have a W-2. All right, um, if you do have a business, your tax returns were just from the years prior. So they might want to know how you're doing this year. So typically on a profit and loss, right, you're going to show the dates. So if we're in March 7th right now, 2023, it's dash cash. Let's say this was the company that I had. Okay, so it'll say like dash cash, profit and loss. Then today's date, but it'll say profit and loss as of the end of February. So February 28th. So from January 1st to February 28th. Why? Because that's how you measure it, to the last day of the last month. And they're going to be looking for, revenues. You're going to put your revenues or your sales. And then underneath that line, you're going to put, your expenses. And then you're going to subtract that out, and you're going to either put net profit or net loss. And you're going to actually sign your profit and loss. So what they're looking for on your profit and loss statement is they want to make sure that you aren't going backwards from your income that they saw on your tax returns. So if you are averaging $10,000 a month on your tax returns, all right, but your profit and loss statement, doesn't look so good, then they could adjust your income downward. If your profit and loss statements indicate that you're doing just as well or better, that's what lenders or underwriters want to see at the mortgage company, because they are lending based on, can you afford the actual loan for the home that you're buying? And so profit and loss will definitely need to be done if you're self-employed. All right. Now, because that affects, all of that stuff affects your debt to income ratio. Now, letters of explanation, they need to be clear, they need to be concise, they need to be signed, they need to be dated, and I would say, print your name and add a phone number. So what's an example of a letter of explanation? So remember how we talked about earlier, let's say you had a $50,000 um, deposit in your bank account, cash, and they're questioning like, what is that? Well, if that's a gift coming from, your mom or dad, that gift letter would be the letter of explanation. All right. Or like, let's say they looked at your credit report and they said, hey, it looks like you were shopping for a car loan, right? Um, did you buy a car? So the letter of explanation would probably look like this. You'd put a date at the top, and then you'd put like a subject. It could be like Toyota financial credit inquiry, and then underneath whom it may concern, and you can put like um, Jane Doe, stopped into a dealership on February 14th, um, just to look at a car. However, they Toyota ran my credit. I did not purchase a car at all, and am not going to be purchasing a car anytime soon. Okay, print your name, sign your name, put a phone number on there. You just want to make sure that that letter is clear and that the underwriter has a good understanding and they're comfortable, like, you know, with that letter. Because if you, let's say you wrote that letter differently, like, okay, I didn't buy a car at Toyota on February 14th, but, you know, I might be getting one soon. Well, they don't know like what that means, right? You might be getting it today, tomorrow, right? Maybe before this loan closes. And at that point, you could jeopardize your loan once again. So make sure your letters of explanation are clear, concise, and like if you're an underwriter, you'd be comfortable with that letter. And if you don't understand it, why would they understand it? So now, income and asset documentation. Okay, so here's what I mean by that. Income and asset, let's now start with the bank accounts or like your 401k. Make sure that if they have numbered pages, that all the pages are submitted. I know on a lot of bank statements, they have numbered pages. Maybe the last thing is an advertisement or some other information. But you know what? The underwriters have no idea what's on that last page. So you need to make sure you're turning that in. Otherwise, it might look like you're hiding something. So, for example, like on a 401k, if it says like page 1 through 10, and you only turned in page, you know, 1 through 7, or you only turned in the summary, they're gonna want all the pages because who knows? What if you borrowed from the 401k and people don't know, right? They're gonna want to know that. And so, anyways, with that being said, that could delay your entire loan once again. So you want to typically avoid all of that as much as you can, right? Now, at Stash Cash on March 7th, 2023, I mean, this is a lot of information we're giving you, but it's here to make sure that you could actually purchase your home, if you're a buyer, and as a realtor, get your buyers in their home as stress free or the least amount of stress as possible. Because this could be one of the most stressful things you ever go into, especially if things get sloppy, out of hand, etc. All right. So here's some more things, right? And I think I covered this earlier. Rates could only be locked um, once you submit a fully executed purchase contract to your lender. All right. Now, we know you want the lowest rate possible. We get that, right? But eventually you're going to have to lock your rate so the loan docs can be produced. So if you're happy with your payment, okay, because we know everyone once again wants the lowest rate, but it's kind of hard to time the market to get the best rate. If you're happy with your payment, right, lock it in so you can actually get your loan going. Okay. Now, when you're actually locking your rate, what you're really doing is you're locking in the time. So what that means is if you lock in the rates right now at 9:37 a.m. on March 7th, 2023, if the rates were 6% at one point, okay, and they were 5.75 at a point and a half, all that means there is that like you've locked for that time. So remember that the example I used for you earlier, if you ran into um, a snag where you needed to lower your rate and buy your rate down by buying points to buy your rate down, okay, paying more for points, then that's what you would be doing for that date. Otherwise, if you don't have a rate lock, now your rate could be completely different. And if you don't have a rate lock, your loan company basically is not printing out any loan docs because you have not established a rate to establish the payment to establish the debt to income ratios. Okay. So here's the other thing. Impounding tax and insurance um, is going to mean you're going to bring more money to close, right? In some cases, you can't avoid that because if you're putting in less than 20% down on a conventional loan, for the most part, a lot of lending companies will make you impound. If you have an FHA loan, which I'm not going to really clearly go into in this talk over here because there's just not enough time, but you will have to impound. So impounding means, your taxes and insurance are being paid with your mortgage. But here's one thing to know, and here's why I made that statement with being that you're going to have to bring more to close. It's because taxes are paid twice a year, insurance is paid once a year. Um, but let's say you close your home, uh, I don't know, let's just say in June. Okay. Taxes were due originally in February, delinquent April 10th, at least where we're at in LA and Orange County. And now let's say taxes again are due in November 1st and delinquent December 10th. Okay, your first payment was in June, all right? But Now your taxes are due again in November, so you made a payment in June, July, August, September, October, um, November. All right. But your escrow company, right, and lending company is going to tell you how much they need to collect up front because they need to pad your impound account. Because once they pay out your taxes when they're due and your insurance, they basically drained out what you gave them and when you paid your mortgage. So they want to make sure you're not delinquent. So what do? They actually pad a little bit, and you're going to have to bring more to the table because now you're bringing in that pad for taxes and insurance. All right. And then sometimes, depending on when you close or when your loan closes um, throughout the year, and when those property taxes, especially are due, that could be a big amount extra to bring in. All right. So typically, if you have the option of not impounding, then you'll bring in less. And if you want to keep more in your bank account, that might be something you might want to do. Um, I'm not gonna say it's an adverse effect, but what the trade-off could be is maybe you pay a little bit more in points because you're not impounding. But think about it like this, right? Like if a lender has a million customers and everyone's impounding, all the lender's doing is holding on to everybody's money and putting it into their bank account. They're making money off the interest and you're not. So if you're good with your money, maybe you don't want to impound because you want to hang on to it and you can pay the property taxes when they're due and the homeowner's insurance when it's due. If you don't think you're good with your money, maybe you want to impound so the money doesn't go away from you. And for some people, they don't want that big property tax payment that's all of a sudden due every a few months or every half of the year. All right, so that might be things to consider. But of course, talk to your trusted mortgage consultant about that, and I'll walk you through. Now, if a buyer, right, or a borrower is tight on funds, right, we talked about this earlier too, you might want to secure a higher rate. I think we talked about the opposite. It's if you needed if you wanted to buy some points to get a lower rate to afford, right? Okay. But what if you're a little bit tight on funds now, right? Like we worked all the numbers in. You have a good debt to income ratio, right? Like let's say it's like 30% and the 40 and you can go up to 45% debt to income ratio. But now like you're just a little bit short on, your cash to close. What can you do? Well, you can get a lender credit. How do you get a lender credit? Well, if you actually do the opposite, right? And maybe take a higher rate now instead of a lower rate because now your points start to go down. Well, if you take a high enough rate, now, right, you start to get credits that are coming over to you. So now instead of maybe 6%, you have a 6.875% rate. And yes, that might mean like, a little bit more on your payment, but now you might have got credit of half a percent on your loan. So maybe if you had $800,000 loan, $4,000 worth of credit that you could use towards your closing cost. So now you have some of your closing costs paid off and maybe some of your property taxes paid off through that lender credit. And now that extra $4,000 is there so you can close your deal, right? So those things get pretty technical, but these are all things an experienced loan officer can help you out as a buyer or borrower, and for you realtors to help out your buyer and make this a smoother transaction for you. All right. So now, once again, submitting a complete package from the very beginning makes everything, everything a lot easier. Okay. But that takes you, the borrower, buyer, okay, and realtors for your customers, that takes them the not just the discipline, but you know, the want or the desire to make this a smooth transaction. If they can do that, everyone is going to be far less stressed. Lenders will be less stressed because what normally happens here, right? If things are going sideways, a lot of times Sometimes not even the lender's fault, but they take the brunt because now escrow is calling them what's going on with the loan. Um, the real estate agent's calling them, hey, what's going on with my buyer? The listing agent's now calling the lender, hey, what's going on with the loan over here? How come it's not moving? Meanwhile, the lender's been trying to get the loan docs, not the loan docs, but the documents needed for mortgage approval. The entire time they've been fighting the borrower or the buyer. So, we want to make sure that the buyer or borrower is invested, not just monetarily, but invested in the process. Because once again, this is probably the most important purchase of their life, and probably the one that means the most, not only in terms of overall expenditure, but in terms of, this is family you're talking about over here. This is you. This is your possible, forever home. And so you want to make sure you treat it as such because it is a transaction that's going to require you to do so. So, let's run through a scenario over here, and I'll just read this off to you, and tell me what your thoughts are on if this qualifies. So the scenario is simply like this. Let's say you have a borrower, John Doe, and John Doe has a FICO score of 780, which is actually excellent. Typically, anything over 740 and above is going to be excellent for most lenders. And let's say John Doe has a gross annual salary here of $200,000. All right. John Doe also has a bank account with $400,000 in his account right now. And over the last 2 months, as proven on his bank statements, it's been over 400,000. Okay, so he's purchasing the home now, what we talked about, like for $1 million. This time though, he's putting down 25%. Okay, down payment is 25%. He's got a 6.25 rate. What that rate transpires to is a principal and interest payment, meaning your mortgage payment, of $4,617.88. All right. He's got annual property taxes of 12,500, and he's got annual homeowners insurance of 3,500. He's got a $50,000 balance on his credit card with a minimum payment of $1,000. And then he's got a car note, for his BMW with $12,000 remaining, and that payment is $800 a month. Now, does he qualify? Why or why not? Right? So I'm going to read this scenario back to you in case you want to try and figure this out when what we talked about before. Okay, so John Doe, FICO score 780, gross salary 200,000, bank account has $400,000, home purchase price $1 million, 25% down payment, 6.25% interest rate. Let's just assume it's a 30-year fixed. Principal and interest payment $4,617.88. Annual property taxes 12,500. Annual homeowners insurance 3,500. He's got a credit card balance with a minimum payment of $1,000, and he has a car note for his BMW that's $12,000 that's remaining, and he has a monthly payment of $800. Does John Doe qualify? Why or why not? This is Stash Cash on March 7th, 2023. I'll simply walk you through this. All right, so let me give you some time. All right, do you actually need, and you might bring up like, hey, I don't have a mortgage calculator. I don't know if he qualifies. Here's the best part. For this scenario, you don't need a mortgage calculator to figure this out. Um, and so why wouldn't you need one? It's because the mortgage has already been figured out for you. Okay, so remember what we talked about earlier. Most lenders look at a 45% debt to income ratio that you cannot exceed. All right. So the first thing I would do here is take a look at what his monthly obligations would be. So this is where like the curveball comes into effect, right? I gave you a payment, okay, of mortgage of $4,617.88. That's a monthly payment. What about homeowners insurance? I gave you 12,500, but guess what that is? That's an annual payment. I also gave you your homeowners insurance, 3,500. That's an annual payment. So what do you need to do with those two? You need to divide that up by 12 months in order to get the monthly payments. So let me go ahead and do that right now. Those two payments by themselves amount to a monthly amount of $1,333.33. Okay, I also gave you two other payments. One of them was $800 for the car, okay, and $1,000 for the credit cards. So let me add those in. So I'm adding $4,617.88 for the home payment. Okay, I'm adding the car payment of 1,000. I'm sorry, the credit card payment of 1,000, the car payment of 800, the property tax and the insurance. Okay, total of $1,333.33. What that adds up to here is a total expenditure of $7,751.21. Now, to figure out if he qualifies, right, um, by doing this exactly how he's doing it, how we set forth, you would take the $7,751.21, divide that by 0.45, okay, because that's 45%. What that means is he need to make monthly $17,224.91. Well, if you multiply that, that's a monthly figure, right? Times 12, that means annually he'd have to make $206,699. Would I say his gross salary was? It was 200,000. So the way he currently has this set up, he is just going to be short of qualifying. But, if you're smart, I did give you some other things on here. And what were those other things? Remember this. He's putting 25% down. So out of $1 million, if he's putting 25% down, he's putting 250,000 down. What did I say he had in his bank account? He has 400,000. So you know what that means? He has $150,000 left. Okay, so what he could do is he could put more money and he could put more money towards a down payment and lower his loan amount. Because remember, if you remember what I said earlier, a lot of times, they're looking for reserves. A lot of times the reserves are 2 months. Okay, in some cases it could be 6 months. And if you remember what the reserves are your mortgage payment plus your property tax plus your insurance plus your HOA. So let's take those things again. So 1,333.33, which is property tax and insurance, plus $4,617.88 is 5,051.21. If I multiply that, right, like let's say by 2 months, that's only 11,902. That means that's how much he has to have left in his bank account. If you want to go 6 months and to initiate more pad, or maybe your lender might need that, then he needs to have 35,000 left in his bank account, 35,707.26 to be exact. Or if you want to do a whole year, he needs to have $71,414.52. Well, remember, he's putting 25% down, 400,000. He has $150,000 left. So what this is telling you here is, is if you can figure this out, he can actually qualify by tweaking his down payment and tweaking his loan just a little bit. So hopefully you've learned something today from Stash Cash on March 7th, 2023. And we look forward to helping our people stash cash and become successful. Take care. God bless.